2013. That's when we launched. Some of you might know me from a previous newsletter that I started in 1989, and actually up until about a month before starting Conrad's Utility Investor. That was my baby there. And when I left there, it was rated #1 for 10-year total return performance, risk adjusted, by the Holbert Financial Digest. So I was pretty proud of that product. I'm even more proud of what I'm doing now. I think we are providing, premier coverage in the not only the utility space, where we cover electric, gas, and water, and so forth, telecommunications, but also on a global basis. And I think you'll like some of the things we're going to talk about today. I hope you'll be inspired to check out the newsletter on a risk-free trial basis once we're done. And that's about it in terms of introduction, unless you have anything else to add, John. But I'm going to give this presentation, and then we're going to have some questions at the end. So I hope you'll all stick around.
No, Roger, take it away. We're ready to go, and I think more and more people are jumping on. So I'm excited to watch myself.
All right. Well, that's terrific. And again, good afternoon, everyone, and welcome to this presentation, which I've entitled Outlook 2018, Risks and Opportunities in Utilities and Essential Service Stocks, which pretty much describes my coverage universe at Conrad's Utility Investor. You can follow along on these slides. Hopefully, most of you are able to or all of you that want to can also download from that landing page that we sent you in the email, and there's also a separate link for loading these slides if for some reason they don't come through clearly. We've been using this Zoom system in the last couple of months and found it to be, and for our paid products as well as for our webinars such as this, introductory webinars. And we found it to be pretty efficient, and certainly a lot better than anything else we found. But we'd also be interested in your comments on the use of the system as well. And again, you can follow those slides from that additional link. First slide here is about briefing goals, and this is what we're going to be going through this afternoon. First off, I'm going to talk a little bit about the macro, the key trends behind 2017 returns, and in particularly in our coverage universe of essential service stocks and utilities. And I think this is particularly important because a lot of the trends that we're seeing in 2017 are definitely look like good candidates to continue through into 2018. So we can also learn from of course, the experience of what happened in 2017. So we'll talk a little bit about that. I'm going to talk about a three-part portfolio strategy that we've been using in Conrad's Utility Investor over the last, really pretty intently over the last year, but going back a little bit further as well. It's uniquely tailored for, I think, the environment that we have. Obviously, my reputation over the long term has been as a long-term investor. So looking for companies, best-in-class businesses that will grow earnings and dividends over time, and thereby realize capital gains as those income streams go higher. And this is a strategy that, a long-term approach that I've used for many years, and I credit as being with the success that I've had. But this is a strategy, again, market cycles mandate different tactics and strategies, no matter what your overall approach is. So this is a simple three-part approach. Again, we've used it particularly most recently, past year or so, as we've gotten into the later days of this bull market, and have been determined to do as well as we can during what's left of the bull market, which history shows can often surprise you, but at the same time protecting ourselves from what comes next by just taking a few really simple kind of steps. So that's what you'll get there. And again, this is an approach we've been using in the newsletter. I'll give you some examples of how we've been doing it and how we intend to use that over the coming year. The top money-making themes for 2018, of course, this is the key the title of this presentation. So we're going to definitely be talking about what we're looking for and what we expect to see happening. What you must absolutely sell now. I think when you're early on in a bull market, this is probably a less important question. Of course, it's the one that everybody wants to ask when everything's going down. Should we stay with this? Should we sell, and so forth? But the problem is probably even more critical when you're we're very close to starting a 10th year of this bull market, which is kind of hard to believe. Certainly, I'm not advocating for an end to the good times. I like them as much as anybody else. But there are a number of things that, and again, this is part of that three-part strategy. There are a number of stocks that you really want to be clear of, and particularly right now while things are going good. And in many cases, one of the things that's difficult about making these sales is that the stocks themselves have been going up for a while, and everything looks good on the outside. But there's a lot of risk out there, a lot of danger. So I'm going to give you some stocks that we are going to be looking to get rid of going forward. And then finally, the last part of this presentation is going to be to type in your questions, and that will I'll be here to answer them as we go forward. You are free to ask anything you'd like, anything about specific companies, larger themes. I'm here to answer. So again, thanks for tuning in, and let's get started with this presentation. So my first slide here is basically showing you what happened over the course of this year, starting at the first trading day and to where we are now. And you can see that it's been a pretty good year for particularly the larger cap utilities. This is the XLU, which is an ETF, exchange traded fund, based on an index of large cap. In other words, the bigger household name utility stocks. So you can see the progress has been generally up. There have been a few ups and downs along the way, but generally we've continued to head higher here. And in fact, it actually looks fairly technically solid as well. If you look at the purple line, that's the 50-day moving average. The green line is the 100-day, and then the yellow line would be the 200-day. And these are kind of standard measures of used in technical analysis that when you're above those lines, you have a fairly have a fairly technically strong sector. So that's all good news. And of course, it's meant that we've had a good year of returns for the portfolios. It's been a nice tailwind. The one thing about ETFs and big cap averages is that they own pretty much everything but the kitchen sink. So there's what I would call strong utilities as well as weaker utilities in this index. What you're getting there is the average, but that is when that is going up, that's a pretty solid sign, a pretty good tailwind rather for the sector. And that wasn't a given when we started this year. Just to think back a little bit here, when I came back from the Edison Electric Institute meeting, and this is something that I've been able to do for Conrad's utility investor readings, get to these big industry conferences where you have executives as well as vendors and so forth, a real opportunity to mingle and ask questions. And again, it really does add a lot of, I found, been very useful. It's given us a nice edge picking utilities. But when I came back from that, we just had an election, and the overwhelming ethos on Wall Street was that we were going to have a period of runaway growth and stimulus, and that stocks like utilities and anything that had to do with dividends were going to crash and burn as a result. And I just want to point out just how wrong that assumption was. And just by looking at this graph, it's another reason for presenting this graph. Again, and I think it also makes a larger point that betting on politics or thinking too much politics can really have a detrimental effect on your investments. So this was definitely not a given that this was going to happen. In fact, this big run that we've seen here in utilities came. It was kind of a contrary play to what a lot of people thought was going to happen, the so-called Trump trade. But again, a big year for big cap utilities. A nice takeaway from this year. Here's another graph, and I'm actually much more bullish on this one regarding utilities. This is a graph. It's courtesy of Bloomberg. It's a longer-term graph, so it's going back about 10 years here. And what it's showing you is dividends. The white line is showing you a dividend yield for the Dow Jones Utility Average in this case, very similar to the XLU. A few different stocks here and there, but again, big cap utilities. So the white line showing you the dividend yield, and you can see it spiked up there in 2008. That's when prices came down. It's been generally coming down ever since. That's very similar to what it's kind of the opposite of what you'd see of if you had a price graph for the Dow Jones Utility Average. In other words, as the prices of utilities have risen, the percentage yield has dropped. But look at that red line. I think that's really more important, and that is the actual dollar value of utility dividends over this period. And it's been a pretty relentless upward climb for utilities. And again, that's because earnings have been rising, and earnings have been rising as utilities' investments in their systems have been rising. So this is a extremely bullish long-term factor for utilities that I think has at least something to do with that big move that we saw this past year. But it has more in common with what's happened with utilities over the last 10 years or so, and that's or since the end of the bear market, which was actually in early 2009. So you can see there's a strong fundamental case for utility stocks going higher. And again, I think this trend is going to continue for quite some time to come. It's almost kind of a different story, though, with the prices. I think that what you're talking about is valuation as being more of a risk for the sector, which has very strong fundamentals. So what were the keys to 2017? First of all, going back to that last slide, I mean, business fundamentals, this is actually the third point here. Business fundamentals are really the best since the 60s for utilities. But the market has mercilessly punished companies that have been weak. We've seen big gains for a number of companies we've been fortunate to own, but also some crippling sector losses. And I'll show you a couple of those. And again, this it sort of goes against the ethos that you can just buy a sector ETF and get a certain amount of the benefit of owning these stocks. There really is tremendous divergence between better performers and lesser performers. So it's very important it was very important last year to differentiate between companies. I think it will become even more important, increasingly important going forward, and as long as this bull market lasts. One thing we are seeing in the utility space, one reason that prices have been going higher, is what's called passive investing. And this is when investors go to your brokerage and they put you in a target retirement plan of some sort. Vanguard has a ton of these things, and they call them retirement plans. And you just tell them when you're going to retire, what your risk preference is, and so forth. And they adjust the investment by algorithm over a large number of ETFs. Well, utilities are one of these, are a big part of these ETFs. They're big companies, obviously. They're part of things like the DVY, which is an index of an itinerant ETF that own dividend-paying stocks. So they're a big part of this passive investing, and it's really pushed a lot of prices up. Now, of course, the big risk is what happens when those algorithms change, when they no longer say buy dividend paying stocks. I think this is a danger for these, and this is why I think we want to really pay attention, why we have to pay attention to valuations in these stocks. And I've done some work for CUI readers and pointing out some of the companies that are out there right now that trade actually at measures of standard valuation, like dividend yields, like price earnings ratios, like price to book value ratios, things that measures of value that have never changed that don't change over time. You can go back in time and measure them where stocks were trading at different times of market history. And one particularly alarming fact is that valuations today for many companies, and particularly the big cap, many of the big cap utilities, they're actually higher than they were at the previous peaks in early 2001. And of course, that was right before roughly a 60% decline in the Dow Jones utility average when Enron imploded. I don't see any kind of fundamental like that affecting this industry at this point. But again, the valuations are certainly where they were at that point before that major catastrophe. Same thing, early 2008 was another time when, and this actually, utilities were in pretty good shape fundamentally because they'd been systematically cutting debt, cutting operating risk, investing in their core businesses since the collapse of Enron, and it really kind of climbed out of the hole, I think, much earlier than most people had thought. But by the time you got around to early 2008, which was right before things started really coming down, and we hit the financial crisis and everything, they were at valuations where we are, about where we are today. And in 2008, of course, it was a terrible year for utilities. They lost, including dividends, right in the neighborhood of about 40% that year. Now, they recovered it pretty quickly. But again, the lesson is valuations got very high. It became very difficult to meet those expectations behind those valuations, and you had a tremendous collapse. So very important to differentiate and look at those valuations. And we do spend a lot of time looking at that. The best opportunities last year, bar none, were in less known companies. I discovered a company that I'd actually followed for many, many years when I was at the Edison Electric Institute meetings in late 2016. And this company was presenting it. It actually had been a Canadian income trust at one point. And they were, I was very impressed with what they had to say. Of course, before I went to the conference, I do a lot of looking at these conferences. I look at a lot of the numbers and, try to participate in the conference calls when I can and so forth. So to be versed on the basics, but this company was planning a New York Stock Exchange listing and wasn't really on a lot of people's radar screen. So, when I got there and they answered my questions and so forth, became very bullish on it. And that company, Algonquin Power and Utilities, became a very hot performer in 2017. I think in part just because people became aware of it, because it did list. It went from being AQUNF, which again, a 5-letter symbol, one of those symbols that I've covered in as long as I've been covering Canadian stocks, that you can buy, but you really need a broker to be a little bit nimble to do so. And of course, the main market for them was Toronto. Well, by going New York, suddenly they got on a lot of people's radar screens, and they also had merged with a company called Empire District that had dramatically increased their percentage of US dollar revenue as opposed to Canadian dollar revenue. So needless to say, as it became more well-known, a lot of people started coming into it, and it actually wound up outperforming a pretty good year by the Dow utility average by better than 2-to-1. So best opportunities are in less known companies. I think it's gotten a little harder to find those less known companies. But again, this is what we do. We cover over 200 companies in our Conrad's Utility Investor coverage universe. We're also looking at other companies outside that coverage universe to add to our the companies that we track, and that does. And combining that by going to these conferences and talking to people and so on, it has given us an edge. And this is a demonstrable case, the case of Algonquin. And I think going forward, the best opportunities are going to be in less known companies. I did go to the Edison conference last month, so I do have some ideas for you. In fact, I'm going to share one with you at the end of as the last item here on the program. But our Conrad's Utility Investor subscribers got a full audio-visual report as well as a text report on my visit at this conference, the key takeaways, the key recommendations, and as well as some stocks to sell. To me, it's one of the more useful things that we did last year or this year rather at Conrad's Utility Investor. And our picks from the year before, of course, did pretty well. And the picks this year, I look forward to doing even better. And again, it's pretty important to try to secure an edge when you're in a bull market that's this old, and that's what we strive to do. The last factor here, I think, might come as a surprise to some people, and that is that Fed policy on interest rates was not a factor. And I've done a lot of work on this issue as well. A lot of people want to buy utility stocks when they're convinced that the Fed is going to lower interest rates, and the mantra. The other part of that is that when the Fed raises interest rates, then you want to be clear of utility stocks. And in fact, the opposite has proven to be true in market history. And this next graph makes that, I think, pretty clear. This is a graph that we started this in December of 2015. This was when the Fed raised the Fed funds rate for the first time in this cycle. And you can see it's been pretty, with the exception of a little bit of a blip there towards the end just looking back, in the end of 2016. And I mentioned that was the time when people were really worried about the politics and so forth. It's been almost a continued bull market. I could have presented another graph here that I have presented to Conrad's Utility Investor readers on numerous occasions, and that is graph of the Dow Jones Utility Average starting back in May of 2013, which was actually when the Fed said we're going to abandon quantitative easing. So you could make the case that was the really beginning of the Fed tightening cycle. But the graph would be shaped pretty much like this one as well. Utilities sold off a little bit following that initial announcement, but again, we're on much higher ground than we were back in May of 2013, just as we're on much higher ground than we were in December of 2015 when the Fed actually started boosting the Fed funds rate. Why is this the case? Why have utilities been able to rally when the Fed funds rate is rising? I know a lot of people are fed the pseudo-economics that when you raise interest rates, then yields on dividend-paying stocks become less attractive, or yields on bonds become less attractive. Well, the market reality is, since this began, and since the Fed started raising rates, we have had the economy continue to grow. So utilities have continued to grow with the economy. Utilities, of course, are kind of in a sweet spot right now because they do have numerous opportunities to invest in their rate base, be it grid investment, be it transitioning from older, wearing out coal-fired power plants to natural gas. Whatever it is boosting rate base, it is cutting costs, and it's raising earnings. So it will continue to be a non-factor insofar as it doesn't affect the economy. It's really all about the economy when it does come to utilities. So again, that kind of goes against conventional wisdom that often is heard and particularly repeated on television and so forth. But that's where we are, and I think the Fed will continue to raise interest rates. But again, as long as the economy is healthy and utility earnings will continue to grow, you can see right here that it's been a bullish time. You go back before to the previous tightening cycle, which was in early part of the previous decade, and utilities actually rallied over a 2-year period ending in June of 2006. They actually rallied pretty close to 60%. So that's again something that we can take advantage of going forward. But at this point, really kind of a non-factor. Of course, I mentioned that one of the factors that the keys to 2017 was an uneven performance. And this graph here is a comparison graph courtesy of Bloomberg that shows you about five different indexes that we cover stocks from in Conrad's Utility Investor. The S&P Utilities is the top one there, number one. That one's in white. The S&P Telecom Index, that's in brown, so you can see that's on the bottom side. And if you look at that white line in between, that's what this graph is showing you is relative, or basically total return. So a rolling total return. If you bought the S&P Utility Index at the beginning of 2016, you can see that you'd have right now return right between here at 16.55% basically. So one of the better performing indexes in our space, and that's the benchmark that we use to benchmark against the other regulated utilities. S&P Telecom Index, again, the red number there indicates that it is underwater this year. Some of the components have done well, some less well. AMZI, the worst performing index that's represented by stocks we cover. AMZI is the Alarian MLP index. So definitely that's been a poor performer this year, and you can see that again in the comparison graph. The IYLCOT is actually a YieldCo index. So this is a group I picked up. Similar in structure to MLPs, although their dividends are treated as just stock dividends, ordinary common stock dividends, so not MLP distributions. But they basically own renewable energy assets under contract that are controlled by their parents. So they're which in many cases are big utilities, big power companies. So it's a different kind of asset class. They're attractive in terms of dividends and dividend growth. And also the nature of their assets is very steady because these wind power assets or solar assets are operated under very long-term contracts. The counterparties are generally utilities or government entities. So the income tends to be very safe. Well, you can see YieldCos have done very well this year. And we've had some big winners there. One of was NEP or NextEra Energy Partners. And this is another pretty good example of how in 2017 and how I think in 2018 will work out in 2018 as well. But in 2017, how less known companies tend to do better than maybe some of the better known ones out there. So another little edge that we give you, but a pretty good, the larger point here just being that there's considerable differentiation in the utility space over the past year. Next graph here, and every year I look at the better performers in a given year in our coverage universe, compare those to the worst performers as well as to the winners from last year. And this is a graph of or table here of the best performing utility stocks or best performing stocks in our coverage universe last year, and how they performed so far this year with about 2 weeks left to go in 2017. And you can see that for the most part, those that did well in 2016 didn't do so well in 2017. This is actually, I guess, a reasonably typical pattern, but I think it maybe explains why you kind of have to look at every year with fresh eyes if you want to get if you want to have the top performers. Of this group, of these stocks, two of them are actually in our portfolios. One is MDU Resources. The other is One Oak Incorporated. And they did, of course, really, really well. 2016, we elected to keep them. And, it hasn't been so much of a disaster to keep them. I think what the reason is that what they've done in 2017 is basically fulfill the promises that investors bet on in 2016. So while they didn't exactly tear up the track last year or in the last year to date in 2017, I think they have set the stage for more growth going forward. So, but kind of interesting here, you can just see that the past isn't always prologue. In fact, most times it's not. a number of these names, we actually did have sells and have had sells on them. Sprint being one, CPL being another, and CPL, which is a Brazilian utility, actually had done very, very well towards the end of the year because a Chinese company, the State Grid, bought a controlling interest and clearly stated that they wanted to take the rest of the company forward. Right now, whatever you have left is just basically orphan stock. So State Grid has indicated it wants to buy it, but I think basically what you've seen is maybe people become a little bit more skeptical. So this is actually a pretty consistent theme that we follow in Conrad's Utility Investor, and that is when a company is being taken over and the current price comes up pretty close to the takeout price, we'll pretty much always recommend you get out of it. The reason being that if the deal should come apart, you could see a big drop in value, and if the deal goes through, then you don't really have a whole lot of upside left for taking that risk. So, and in the case of CPFL here, it's that I guess that a third way that things can go wrong, and that is that the deal still stays in place, but the would-be buyer kind of doesn't make a move and waits for the price to come down to a level where it is more economic for them to buy. So again, it's kind of why we have that rule in Conrad's Utility Investor. But the larger point of this slide is that what does well one year typically won't do well the next. So you got to look at every year with fresh eyes, and that is actually what we're coming up on here, and is a January issue that will look at our top picks, look at our pans, and kind of give an analysis on where we think that the big winners and losers from 2017 will be heading next year. So that'll be a pretty fun issue to write. I think you'll have a lot of points of interest, and we've done that the last few years, and it's generally been pretty successful. Another point that just kind of rounding out the points of 2017, and that is that differentiation between various stocks within a sector was frequently more important in terms of driving returns than how the sector did as a whole. So what I've done here is pull out our foreign utilities, or companies that are based outside the United States, compare that to the S&P index. So same sort of thing as in that other graph where I was comparing the different indexes, but you can see that performance has been pretty varied. Our best performer in this area, when you buy foreign stocks, you're also going up against the currency, changes in the currency. So that becomes pretty important, what countries you pick, as well as how well these countries are doing, what their home currency of origin is. But our best performer was a company called Suez Environment, and that's a European water company. It's actually one of the original concessioners that Napoleon granted back early in the 19th century for operating a water system. It was actually Suez Lyonnaise, and that serving Lyon. But now this company has grown into a major global player in the water sector and in the waste sector, and with operations in the U.S. and in China and so forth. They did a really big deal buying GE Water, General Electric's water assets. So these are good assets that a distressed player has been selling. It's always a good way to expand your business. And this is a company that had lagged for a long time, but we were able to catch it at a good price and make a nice return. AGL is an Australian utility. That was our second best performer, and that and NTT. Those were the three that did beat the S&P index. It's not really a fair comparison, again, because you're comparing companies that are priced in different currency. But you can see that we did fare very well with those picks. BC are the laggards here, Telefonica and BCE. Some longer term holdings that we've had. BCE is, of course, very steady Canadian telecom, and it did very well last year. So that probably has a little something to do with the return that was less than the S&P. But this one has also done much better in bear markets. So this was actually a time where this is a sector where, or if you want to call it a sector, our global utilities did very well. Our next graph here, our midstream companies, we're definitely more of a mixed bag. We did generally outperform the Alerian MLP Infrastructure Index, AMZI, which you can see was fairly deep in the red. In fact, we outperformed pretty handily with our Canadian midstreams, our one and as well as Dominion Resources, which is a utility that owns extensive pipeline assets. So we did these again. These are all portfolio companies we had last year. Our underperformer, and in fact our worst performer in the portfolio last year by far, was Buckeye Partners. We still think this name will crawl out of the muck, as it were. We think that there is a possibility of a distribution cut, but it's definitely priced in for the company. And it would frankly be a surprise to us because management historically has eschewed that type of approach. They don't have any IDRs or incentive distribution rights, so that keeps their cost of capital low. The very nature of their business is very low risk because it's based on 98% based on fees. And the terminals and so forth that they acquired when they did this venture with a company called Vitol SA, a global fuels company, really has a lot of potential for adding new capacity around the world. And of course, trading of liquids and so forth, and fuels and refined products, crude oil as well, has been fairly robust. So this company is, we think, in good shape to make a substantial comeback. But for the most part, you can see that we have outperformed the Alerian index by a pretty strong margin. And the Alerian had a bad year. We think this will actually be a better year. But again, this was a theme of 2017. Some of the pipelines did prosper, and some did not. So we think this will be something that we'll see more of next year. Why put your trust in Conrad's Utility Investor? I mentioned earlier my track record, how long I've been around this industry. It's about a 30-year track record, and it's been pretty focused on utilities, essential service stocks, big yields, robust, reliable growth, that sort of thing. It is documented. You can go back and check me out with previous rating services and so forth. We also put our current and performance of current and previous recommendations. You can view that and always on our site, and the prices are always updated and so forth. So pretty proud of that record, and I do think that it does give me some insight that it does increase chances of success. We have some bottoms up focus. We have over 200 names in our coverage universe. Of course, those names, some of them drop off, some of them come on. We'll probably have a few new names in this upcoming issue, mainly because we've seen a number of mergers take place among companies that are in our coverage universe. So that's a good way for companies to disappear. It's been pretty much a constant as long as I've been covering this sector, and it's really the history of utilities, more and more mergers. But at the same time, there are other companies that come into play. We've got a pretty extensive global utilities coverage universe. You can see from that slide a couple slides ago, we've had a pretty good rating, record of success with those. But that's what we do. We focus on individual companies first. So that we look at the macro, but we want to know primarily how companies are doing. Are they going to be earning their dividend? Are they going to be growing those dividends going forward? Are they going to have upside from this point? just in very short time, I'm going to talk to you about our 3-point strategy for our 3 model portfolios. We do have 3 model portfolios: a conservative, where our focus is on dividends as well as growth that comes from rising dividends. We've got an aggressive portfolio where we're looking at some of the companies that rate a little bit lower in our coverage universe. And we do rate all our companies by a quality grade system, A through F. And sometimes the conservatives will be, pretty much all A's. But sometimes we will find some companies that we believe to be on the come that eventually will be A's, but currently rate maybe B's or C's right now, and that offer compelling value. So that's what our aggressive portfolio is all about. And then our top 10 drips. This is a savers portfolio. I've used dividend reinvestment plans pretty much as long as I've been in the investment business. And I think those have been some of my best recommendations, and certainly some of my best investments have been these dividend reinvestment plans where you just buy the stock and reinvest the dividends every quarter as they come, and in new shares of stock. So you get the benefit of compounding, and it's really quite astounding what can happen when you when you do that. You make that commitment and just lock them away. And in many of the companies that I've had, companies like Aqua America or Dominion Resources have just pretty much like clockwork increased my wealth as they pay dividends and on a compound basis. So that's a strategy that I wanted to share with others and subscribers. So we do have our top 10 drips, and that's a portfolio. And again, that's a kind of a savers portfolio, and particularly appropriate for younger investors, and I think as well as for older investors who may want to put something away for some younger investors. Always a worthy endeavor. So that's the nature of those portfolios, and you get them updated. And we do have always on the website, and we do have 2 recommendations of the month, 2 stocks every month in our issues. One will typically be from the conservative, and one typically from the aggressive. Sometimes there's a drip plan thrown in there as well, but that's what you get in every issue. And then, of course, Conrad's Utility Investor. Today, I'm talking to you here on this webinar. But if you do join us, you'll get issues, alerts, roundups, special reports, such as the Edison Electric Institute report that I mentioned, where I make a number of recommendations and for buys and sells. And then we do have quarterly chats as well, and we'll have a quarterly chat coming up next month. So if you do join us, you'll be getting a notification of that. The actual date of the chat, I believe we're right now scheduling for the first Tuesday after the issue comes out. So that'll be second week in January, and pretty much those things are, you'll find they're kind of no holds barred type interaction where they're whatever is typed in, I will answer. And again, that's something that I like to do because it keeps me informed of what people want to find out about. And sometimes it alerts me to areas that I can improve the issue, things I've left out, and we always like to hear from everyone. So and you can read what other people are asking as well. So that's which I find is often helpful for people who may feel like they can't ask something. But in any case, it's a good time for me, and it's a popular feature with our readers. So that's why I think you should put your trust in Conrad's Utility Investor. And now I want to talk about our 3-part portfolio strategy just briefly. Again, I would say that the primary thing that we do, the primary edge that you'll get from this newsletter over, say, buying an ETF or anything else that's not this focused, is that we do show you how to differentiate the sector. And if you look at, if you go back, remember that that slide I showed you where one of the stocks in our coverage universe was up somewhere around 150%. There were stocks that year that actually dropped as much as 30 to 40%. So in the coverage universe, so differentiation is quite important. It's even very important when you narrow it down to certain indexes, because even in the Dow Utility Average, the percentage difference between the top performer and the worst performer was about 50 percentage points. So differentiation does matter. Don't ever let anybody tell you any different. And point one of our portfolio strategy is to take advantage of that differentiation and sell the weak from your portfolio. I've mentioned I have 200, a little over 200 companies in the coverage universe now. Well, 68 of those companies we rate sells. We also have an endangered dividends list that I'm going to talk about a little bit later. And those are, the vast majority of those are sells as well, because simple reason that they're very likely to cut their dividends in the very near future. But 68 companies, that's almost a third. Well, actually, it is more than a third of the total companies that I cover. It's a function, having this many sells is partly a function of the fact that we're this far into the bull market. It has to do with valuations almost as much as actual weaklings, but that's a lot of companies to be sold. Now, the weaklings are actually much more important to sell than the ones that are just simply at high valuations, for the simple reason that if they're reporting poor results right now, what do you think they're going to do when conditions worsen, when we don't have a very low cost of capital out there with interest rates low and stock prices high, when we don't have robust growth, when we don't have credit markets that are wide open? And, there will be a time when we do have those conditions, when things do tighten up. And companies that aren't doing well now, when the sun is shining, are certainly not going to do well when the storm comes. So it's very important to get rid of companies that are on the weak side in your portfolio. Another thing that so that's part one. Part two, this concerns companies that are extremely high priced, trading at very high valuations. We have value-based buy targets that we give for really every stock in our coverage universe, but they're particularly important for portfolio companies. So every time we have a portfolio update, which is at least every issue, but sometimes it's in between issues, we'll talk if there has been a major market event. We'll do that in feature like utility roundup, or alternatively in an alert that will be sent out. But we do look at the companies in our portfolio. We compare their current prices to the prices that where we would be buyers, and we express that in terms of quarters of dividends. So the point being that if the stock should drop from where it is currently back to what we think it's worth paying to buy it, what would that loss mean in terms of quarters of dividends? How many quarters of dividends would it take, in other words, to make up for that drop in price? And there are a number of companies that have reached a threshold where you would have to have, where it would take 25 to 30 quarters of dividends to make up for the kind of loss you'd have if you just came back to a more normal valuation. So you look at some of those, and some of them actually would rate out and out, just out and out sells you just want to get rid of. But for the most part, you're talking about companies that are strong, that right now are probably in the best shape they've been in since the 1960s. These are companies that can build wealth over a long period of time. So you don't really want to sell the whole package. And in fact, in some cases, those prices are so high that they would incur a fairly substantial tax burden. So you want to take what's called a partial profit. You can just selling a little bit of it. And of course, they did not do away with the first in, first out taxation of stock when you sell it. So you can still do that as an individual investor. Basically choose which shares of stock you want to sell. So you don't have to sell your most the ones you bought at the most expensive time. But you take a little bit of money off the table at this time. You will have, in combination, if you sell the weak, hopefully you don't have so many weeks right now, but if you do have only really strong companies, you can get the same benefit, and that is get a little bit of cash and build a list of cash that you can deploy. And it should be in a fairly liquid place that's, I would actually, that's maybe earning a little bit of interest, but you want to be able to deploy this cash quickly on stocks that are the best in class that you can buy when prices come down. So, and that's part 3 of this of the strategy. Now, we've actually employed part 3 of the strategy numerous times over the past year or so when individual companies have come down, and I'm going to show you a few examples of those. And I think this is another way that we're going to outperform over the next year. You don't see it so much in I guess our overall portfolio figures, but several times over the last year, we were able to get into some really stocks of what we consider to be really first-rate companies at extremely low prices and then ride them back up again. So you don't necessarily have to hold this cash until the end of the bull market. I guess that's the main point. There are opportunities along the way that you can buy best-in-class stocks at low prices when things shake out. And we, again, 3 portfolios, conservative, aggressive, top 10 drips, and we're applying this 3-part strategy rather over those portfolios. So that kind of explains what we're doing there. I want to give you a few examples of how we intend to do that and of what we might see going forward. But first, let's take a look at the top themes for 2018. This is first point I've made a couple times already in this presentation. That's that valuations right now start at all-time highs, well above early 2008 and early 2001 peaks. Just means that expectations are very high, and if they're punctured, prices can come down in a very very big way. Passive investing is driving share prices higher now. I mentioned that was a big trend in 2017, and it continues to be the case right now as money comes into these retirement funds and so forth that just deploys money over a bunch of ETFs that hold dividend-paying stocks. That pushes prices higher. Could drive them lower later. In fact, we've seen a couple of flash crashes over the last couple of years. We've also seen things happen to individual stocks that drop out of certain algorithms as well. So what passive investing giveth, it can taketh away. And I suspect that at some point in 2018, we're going to see some pretty harsh examples of this. So this just makes us cautious. Both those top 2 factors make us cautious and make us, while we see value out there, it makes us want to protect ourselves where expectations have become very high. Best in class are still getting stronger as businesses. This is very hopeful in terms of how these companies are going to wind up at the end of the cycle. So we go through a downturn, come back up the other side. As long as the underlying businesses of these companies are getting stronger, they're going to wind up in a better place. But again, so this is something that makes us very confident, but it's only kind of it's bounced off against that valuation argument. Fed policy tax reform will bring opportunities, but they're not going to be game changers. And when it comes to Fed policy, I think it's going to be, of course, interest rates continue to go higher. We may get some sell-offs in some of our stocks based on that fact, particularly if it's a scare that lasts more than a couple of weeks. But again, that's been an opportunity to buy throughout this bear market and some bull market rather, and we think it will be again. In terms of tax reform, this tax bill is very complex, but it looks like things have come out pretty well for the companies in our coverage universe, and particularly a number of our portfolio companies. We will have an extensive report on how our portfolio companies and coverage universe companies are affected. That will be in a utility roundup that subscribers will see in the next couple of weeks, assuming that this tax plan does pass. But one reason I haven't really been that concerned about tax reform, since over the last couple of months simply goes back to, my appearance or attending the Edison Electric Institute meetings back in early November, because that was when people started seeing some of the details of what tax reform are going to look like. And the Edison Electric Institute, which not only holds these great conferences, but they're also the leading lobbying arm of the electric utility industry, was very heavily involved early on. And the word at the conference was that they had gotten what they wanted, or they were being heard, and that whatever happened would not be catastrophic, would probably benefit some parts of the business, hurt other parts. And that's pretty much seems to be what has come to pass. So again, another nice benefit of hanging out at this type of venue. But there will be some opportunities, and again, and some will be hurt, and that's what I'll be covering in this report. Differentiation, I think, really pretty much sums it up. It was important. It was very important in 2017. I think it'll be even more important in 2018, when we could see some of these big tailwinds that have helped the sector as a whole start to either dissipate or actually come back and be headwinds. So it's going to be very important to pick your spots and pick your stocks and pick your buy prices at that time. And this will be a big focus for us in 2018. And then again, this goes back to the 3-point strategy that I mentioned. You always want to sell business weakness right now. You really don't want to be hanging around holding and hoping at a company that is struggling when cost of capital is relatively low, when the economy is percolating along fairly well, because these are always the companies that will really blow a hole in your portfolio when things start to head lower. So again, we always sell business weakness. We point it out to you, and I think this is very much a top theme for 2018. So I mentioned some of the tactics that we're using. One is simply buying dips of companies that temporarily take it on the chin. This was Dominion Resources earlier this year. It's actually a 12-month graph. But if you look at that dip down early in the year, that occurred when Dominion temporarily seemed to throttle back on its guidance for the full year. It's kind of hard to remember that at this point. And of course, the stock has gone on to bigger and better things as management has actually worked through some of the difficulties, and the stock has punctured back out to new highs. The takeaway here is that you buy these things when the prices come down. There were a lot of people who were very worried about Dominion. We know this company pretty well. We looked at it in more detail, of course, after that price came down. We made the judgment that things were still going pretty well and that the market had overreacted. We put out an alert to Conrad's utility investor readers, and again, that's been a pretty successful call for those who picked up shares at that dip. Same thing a little bit more recently with AT&T. This has been a long-term holding of ours, so a lot of people have held it from a long way back. We've had a buy target of 38 on it for quite some time. Haven't gone above that, even though the stock has gone above that at various times. But what happened back here in November, late October, early November, is the company issued a guidance warning that they had lost more cable customers than they had anticipated, an acceleration from previous quarters. And as a result, they sparked this massive narrative about cord cutting. And that just percolated all through the financial media. And the case being that AT&T's number indicated that we would see more defections from pay TV networks, and that margins would be crunched, and so on and so forth. And so everybody took this number, jumped all over it. It's kind of an appealing narrative, I guess, in some respects. It's certainly one that's easily accepted, that people are cutting the cord. We've certainly seen the cutting of the cord of wireline phone companies, but as per usual, people just went way overboard on this. Didn't really listen to the company explanation, which that earthquakes in Mexico and storms in Texas were responsible for a big part of the drop, or that they had been signing more people up for another type of price plan, which is actually a little bit more suited to millennial buyers, and that had been pretty successful. So people ignored that stuff and went ahead, dumped AT&T. We sent an alert out. We said that we thought the company is still solid on the inside, that all the important things were happening for them. And even though the Time Warner merger was hung up, which remains hung up, even though the pay TV business is very competitive, that their wireless business is doing well, they're still generating a lot of free cash flow that's putting them in the lead for 5G wireless. All the important things were still lined up for AT&T. They're going to raise their dividend, we said, and they have raised it. And as a result, when we sent that alert out, said buy it, and as you can see, the market did come back to its senses, and this thing is actually now back over our buy target where it has been for prolonged periods of time. So again, a nice little opportunity in this market where valuations are pretty high and values are scarce. Just buying something that's come down, and that's what we do. When this does happen, we get those alerts out to you. Verizon is another one, kind of along the same lines, and that was it was actually an easier call because it was dragged down by kind of guilt by association with AT&T. So they posted pretty strong third quarter results. Thing popped back up, and those who bought when we pointed out the opportunity, stock is now actually above the buy target that we'd set around 52. And again, another good example of how you can take advantage of this type of selling that we see in a market that's so momentum driven to buy good stocks cheap. And we intend to do this a lot more in 2018. Differentiation is another, of course, kind of a code word, or not code word, but a mantra that I've been repeating throughout this presentation. This gives you a pretty good example of how differentiation can be important and was important over the past year, even among pretty solid companies in the same kind of family. This compares NextEra Energy Partners, which I mentioned a little earlier as a recommendation, to NextEra Energy. NextEra Energy is the parent. NextEra Energy Partners is the yieldco spun out of the parent. And at the beginning of the year, we started to become a little bit more concerned about the valuation on NextEra, the utility stock, and we noticed a pretty nice value in NextEra Energy Partners. We kept our hold recommendation on NextEra Energy for the most part, and we said, instead of buying NextEra Energy, why not buy NextEra Energy Partners, which has a bigger yield, a stronger growth platform, and is, in comparison to NextEra, is actually undervalued. And as you can see, just holding on to NextEra has been pretty profitable, but buying NextEra Energy Partners was a lot better deal. And in fact, if this graph had gone on past the 12th of December, it would show actually NextEra Energy Partners up pretty close to 75%. So more than twice the return on NextEra Energy, the parent. Again, it's kind of a happy differentiation, but it's one nonetheless that made a real difference in terms of wealth. And I think we'll see more of those types of situations in 2018. This is more of a this is a comparison between Southern Company and Scana, and this is more of an example of how differentiation is the difference between positive return or a extremely negative return. And both these companies are based in the Southeast. They're so they have pretty favorable regulation. That tends to be the case in the Southeast. They have pretty good customer growth trends, pretty new fleets, pretty new assets as compared to some of the utilities in the Northeast and in the Midwest. Both these companies have also one other thing in common, and that is they both began building new nuclear plants based on the AP1000 design by Toshiba Westinghouse. Westinghouse, of course, now being bankrupt. And these plants came out of the drawing board back in the last decade. Southern Company and SCANA, Southern Company in Georgia, through its Georgia Power Unit, and SCANA through its South Carolina electric and gas unit in South Carolina. They got approval from state regulators to build these plants. The state legislatures passed laws that allowed them to recover the costs of building these plants as they were incurred, rather than waiting for building the plants and waiting for a rate increase after they were built. And this was a huge difference from the last generation of nuclear plants, where companies basically had to do all the work, pay all the bills, and then come around and ask for rate increases. And of course, regulators in many states, including Georgia, rejected much of the cost and declared it imprudent, and thereby the utility, in this case Southern, had to write off a large amount back in the early 80s. Well, they didn't make that same mistake twice. And in fact, the companies, before they agreed to build, they got this legislation. So that's been kind of a saving grace, because both these plants, the volatile plant in Georgia and the Summer plant in South Carolina, really busted the budget, and they've extended the construction times already by several years. So SCANA, we looked at back earlier this year, and because this problem was well known, it's kind of like a slow-moving train moving towards you. But we reasoned that comparing Southern to SCANA, that Southern, because it is a much bigger company, and had merged with the big gas utility, crosstown gas utility in Atlanta, AGL, was actually much less dependent on this project and could absorb the blow of not getting this project built if there were a problem. Whereas SCANA, if something happened where they weren't able to build this thing, it would be a out-and-out disaster. So we had a long-standing sell recommendation on SCANA. We had maintained our buy recommendation on Southern, but not at the price where it was trading. We kept it right around 50. And again, as a cautionary term, but we stuck with Southern. And I think again, this graph here shows the value of differentiating between those two nuclear builders. The Southern, with its stronger balance sheet, with its larger revenue base, and so on. The volatile plant has suffered cost increases as well, schedule delays, and the bankruptcy of Westinghouse, which is that forced them to withdraw as lead contractor. But because of their larger scale, because of their bigger revenue, stronger balance sheet, all that, they've been able to more or less ride this thing out. And in fact, this project is still going forward. There's still some things that have to happen for this thing to become reality, one of which just is executing on building it. But if you look at what happened here, SCANA, when again confronted by pretty much the same set of hurdles as Southern with its project, their partner Santee Cooper actually withdrew from the project, and that forced SCANA to abandon the project. So that landed them in a lot of hot water, and a lot of people in South Carolina want them to actually roll back those rate increases. And doing so, management has rightly stated that it would basically cause severe financial distress. Incidentally, so it's no question that that's why this comparison graph, you can see SCANA going down a whole lot, Southern basically hanging in there, and in fact matching the performance of the S&P Utility Index. As I can say, incidentally, SCANA at this point, trading around book value, has become a little bit more interesting. So we may have another differentiation trade for you there starting next year. But at this point, again, the larger point of this graph, differentiation was the key to avoiding SCANA and staying with Southern. And again, I think this will be a big theme in 2018. talking about 2018 and 2017, I mentioned this company Algonquin. One of the keys being that buying less well-known companies that didn't have so many people covering them. And it's been hard to do in the utility space because utility space has been picked over for a long time. I think that one thing you can say is that it's become a little bit more specialized in recent years, maybe a little more popular to cover. There are not a lot of people that have been covering this industry for 30 years. That's something you can look at just with any kind of analysis of who's covering these things, or people managing funds and so forth. But there are probably a fewer number of people covering these things. And when it comes to a company like Algonquin, not a lot of following. So I saw the opportunity at EEI, and that was a pretty good place to be, as you can see from this graph. And in fact, this is a company that I also featured in the most recent report, EEI 52, that you can read more about it there. But again, company not a lot of people had heard of. It's now a big major U.S. utility. They trade New York, and I think that's responsible for a lot of that gain you see. Another one of our EEI 51 picks, the 51st annual Edison Electric Institute Financial Conference pick. That was which was actually out in Phoenix. It's a company called IE Nova. So this is a unit actually of Sempra Energy that operates in Mexico. They own power lines, some power plants, and also natural gas power or natural gas distribution, a whole lot of energy infrastructure. And Sempra Energy is, of course, the primary owner. They own more than 2/3 of the stock, and this is their vehicle for investing in Mexico. So as investors, you really have an opportunity to latch on. Well, this became my pick a year ago because I had really thought that investors were overthinking what would happen in regards Mexico and the United States under a Trump administration. And this company has had a lot of projects in place. We think it's in some ways perhaps a kind of a proto-MLP, kind of where some of the MLPs were at one point. A lot of projects. Of course, the Mexican peso coming off a little bit against the U.S. dollar has been good for Sempra Energy to invest more money in Mexico. And the result has been a pretty successful post-conference pick. But again, not a company that a lot of people have heard of that we did pick up there, and was one of our picks, and has done well. And as you can see here, it's done from this comparison graph, which the white line being IE Nova, the red line being Sempra. It's done better than its parent, and pretty much in proportion to the outperformance of NextEra Energy Partners versus NextEra Energy. The date here goes back to the date of 11/10/2016. That's the date we released that Edison Electric Institute 51st annual conference, my report from that. But as you can see, again, differentiation and going for some of the companies that aren't known. That's going to be a big theme in 2018. What to sell? This is again an area that I think is very important to consider. We have an endangered dividends list that we publish. It's always up on the website, but we comment on every month in every issue. Right now, we have 3 wireline telecoms, 6 big cap master limited partnerships that a lot of people own. A lot of people own companies in both those groups. 3 European utilities, 2 global telecoms, 1 of the big oils, which is fairly extraordinary because big oil has proven its resilience yet again during this downturn in energy prices. 1 closed-end fund, mutual fund, an energy marketer, and 2 big cap U.S. utilities. So that's our endangered dividends list right now. And most of these companies are rated sells. Again, they're doing poorly at a time when they should be, when they're rivals, and when they should be doing pretty well. When they have a low cost, when overall cost of capital is low, when the economy is doing well, they're floundering even then. So what's going to happen when things go down there, and when times get to be a little less favorable? In all these cases, I think dividend cuts would trigger big capital losses. And in addition to dividend cuts, it's kind of the unkindest cut of all is what you often see when a company that pays a big dividend still has a lot of investors that are counting on that dividend, eventually cuts or eliminates. All that money all those people sell, and prices crash and burn. And a lot of times it's institutional money that's coming out of there. So it's going to come out of there, or it's money controlled by algorithm. So it's going to come out of there on the signal of a computer. It's going to come out of there a lot faster than you or I can make our move. The way you protect yourself is to get out while the getting is good. Don't wait around and hope that a dividend's going to hold. You want to get out of that name. And again, very important part of Conrad's utility investor is what to sell. Here's a couple of examples that are on the list right now. One is Feral Gas Partners. Yields over 10%. Of course, it has just recently cut its distribution by more than 80%, and that corresponds to to that drop in the that you see. But it's resumed its downward slide, and the reason is this dividend cut wasn't just an isolated event. It wasn't just something that and it wasn't enough to right the ship. We were at a conference, and this is another conference that I report on for Conrad's Utility Investor Readers. It's about 6 months after the utility conference. It's called the MLPA, or Master Limited Partnerships Association Conference. We go every year. We've been going for most of this decade, and it's always a great place to meet people and see the people running these things. And sometimes you really pick up some great bargains, and sometimes you really get some red flags. And this was one that we saw as a huge red flag back in 2014 when they came and were talking about buying midstream companies. So here was a propane distributor trying to get involved in a fiercely competitive business, and they made their purchase right there at the top in the energy market. Of course, we didn't know that oil prices that was the absolute top. We did have an inkling that, and we did make a forecast that in our companion newsletter to Conrad's Utility Investor, which is Energy and Income Advisor, we did start talking about $20, $30 oil when oil was well over $100, and that was informing our view on this as well. But it just seemed to me that at the time that they really didn't have a good explanation for why they were getting into this business, that they were ill prepared. And that's pretty much what's been borne out, I think, going forward. And from that point, the company they bought called Bridger, all those executives, I guess, stuck around as long as they needed to collect the selling price, but they left the company with just a lot of holes in it. And what you have right now is they're desperately trying to plug them. I think this is a company that we could see a Chapter 11 being filed. And MLPs that do file bankruptcy tend to be real disasters, because not only do you lose pretty much all your investment, but you can actually be liable for the partnership's other investments because of the partnership structure. So definitely a name we're advising people to get out of, just as we've advised getting out of it when it was 10 times higher in price. It's a decaying fundamentals, and you can, a lot of people may not want to look at the financials. I mean, they're kind of a nightmare to read through, but you can definitely see from them just kind of a lack of what appears to be just sort of a lack of cogency in what they're trying to do. So no, this is a 10% plus yield that's not attractive, and it's on our endangered dividends list. Another company that is also on the list is a company called Frontier Communications. This is one we played around with in the past, but there was a certain point reached, I guess about a year ago, where it just became pretty clear that they were walking down their guidance. In other words, they were, every time they would announce earnings or make a guidance for going forward, it was always worse than the previous time. And the worst part of it was, basically talking about cord cutting, was that they were losing customers hand over fist, not only in the basic phone line business, but also in the broadband business. And a lot of debt there. And so we made the judgment to get out of what we had were the Frontier preferreds, which were mandatorily convertible into common stock in June of 2018. And we didn't see a lot of good happening for Frontier. So we actually had to take a loss on that. But by taking the loss that we did, we avoided a extremely precipitous drop from there, about pretty close to a 90% drop from there. So I put this slide up here not to show that how great we are. Certainly, taking a loss isn't anything to brag about, but mainly just to show that, when you do have companies that are weakening from the inside, it pays to get out of them, even if you're taking a loss. The next slide here is Windstream, and it also pays to get out. That's what this graph shows. It also pays to get out even if you are sitting on a pretty good gain, even if things look pretty good. In fact, that's the best time to sell if you're lucky enough to be able to see signs of weakening within the company at the same time everybody else is out there buying it. That was the case with Windstream back in the middle part of 2014. It was actually my birthday. This graph actually starts on my birthday, July 30th. And it's kind of a birthday present for me because they announced at that time that they were going to do this deal to spin out their infrastructure assets, their towers and fiber and so forth, into a new company. That company has since changed names. It's now called Unit Corporation, and they're trying to get away from Windstream as fast as possible. But one thing that we noticed with this particular proposal, this deal, was that as they made the spinoff, the overall and you had to do some pretty high level math, I think, to figure this out. But when they made the spin out, just based on ratios and so forth, the actual value of dividends paid to existing Windstream shareholders was about to drop by about 30%. So didn't really see this as a very good sign. In fact, we called it a stealth dividend cut at the time. But because everybody got all excited about the spin out and making these things into REITs, that was the Real Estate Investment Trust, a lot of excitement going on about that, and a lot of buying came in on this particular name, and we took the opportunity to exit. And this one no longer pays a dividend at all, and could very well be a bankruptcy candidate. So, you make these decisions to sell based on risk to the dividend. And if you look at the endangered dividends list, you'll see that not all the companies are at death's door, but there are all sorts of reasons why you want to sell, and or rather all sorts of times when you want to sell, and they all boil down to one reason, and that is weakening fundamentals. So this is one that's actually also rated a sell right now, even though it doesn't pay a dividend anymore, so it's not on the dividend watch list. That Unit company is also on the dividend watch list as well. That owns the REIT, owns the infrastructure that Windstream uses, and the main reason is because over 3/4 of its revenue depend on a contract with Windstream that should Windstream go bankrupt, should Windstream try to negotiate it down to avoid going to bankruptcy, revenue would drop from that contract and would have an immediate impact on Unit's ability to, or Unity actually, the symbol is Unit, its ability to make good on its dividend. So again, selling, very, very important in 2017. And I think it's going to be extremely important in 2018 as well. So before we get to the Q&A part of this, I just want to say 12 monthly issues. That's what you get with Conrad's Utility Investor with my top picks. We have 3 portfolios. To reiterate, conservative, aggressive, and a top 10 drip. Within those portfolios, we have conservative and aggressive components. So, you got some more conservative, some more aggressive than others, in other words. And we do have ratings for each of the companies that we have. Top 10 drip model portfolio. Also, again, great for savers, and one that I personally rely on. And they're always tracked. You can always go to the website and check them out. 200 plus company coverage universe with trading advice, live quotes, and a lot of other information on there that is useful, that we consider useful and in helping you make your decisions. Every issue has a very large section on comments for each of these companies. Every 3 months, it will be on earnings. It will also be also in the rotation are quality grades, and I break down the quality grades, how each individual company rates on each of the criteria. And then the third one will be the third month is will depend on what's something more topical. We of course have all vital news in there. We have payout ratios. We change our buy, hold, and sell targets, our buy targets, and so forth. That's what you get in the coverage universe. And of course, alerts, special reports, utility roundup, and quarterly subscribers only chats. And that's what we that's more or less the what you get with this. Again, the chat, as I mentioned earlier, will be in early January, and in fact, right now the date that we're looking at is January 9th, which would be a Tuesday. So if you join us, you'll be able to participate in that and ask any question that you'd like. But before we get to the questions, I want to also talk about, I mentioned a name that I would just give you, and this is one that is one of our portfolio picks. It's also it was also featured in the report, Edison Electric Institute report that I did from the 52nd annual financial conference, and it's called AES Corporation. And AES Corporation is a power producer. It's also a regulated utility. It's a leading producer of solar power. It's a leading energy storage company, and it's also a company that's on the recovery. It's the only company in the Dow Jones Utility Average that does not have an investment grade rating, but management has made a priority of getting there and getting those metrics by 2019. They just announced a major deal where they're going to be selling many of their assets in the Philippines, which will reduce their risk. Philippine regulatory environment is fairly risky. It also decreases their exposure to sources of energy such as coal, which are problematic in many countries. And most important of all, it provides cash to reduce debt, and be another strong step once that thing closes to restoring that to investment grade metrics. At the same time they're doing that, they're also increasing their dividend by 9% plus a year. And they're doing that by virtue of bringing a number of projects, a very visible project pipeline for capital spending online, and thereby generating cash flows from that. So this is a company that I think people are waiting to see that investment grade rating, perhaps, maybe waiting to see more progress on its long-term recovery goal. But right now it trades at right around 10 times trailing 12 months earnings. That's that's by far the lowest valuation in the Dow Utility Index. It's a very low valuation in the sector. as a whole. So you're getting a pretty cheap stock, growing its dividend, which the yield is over 4%, and growing that dividend pretty close to 10% a year in a very reliable way. This graph here just shows how it's performed since the report that we sent out. So you can see it's the report we sent out on Edison Electric Institute 52nd Annual Financial Conference. So you can see it's pretty much around where it was at that point when we did initially recommend it. But it's definitely, again, a stock that is on the rise. And again, the big reason, going back to that graph I showed earlier in the presentation, a big reason that I think this thing is going to head a lot higher is simply the dividend going higher, which is indicated by the dollar amount is indicated by the red line there. Now, what the white line is showing you is, I think, intense investor skepticism that this is actually going to happen. And that tends to be a pretty good combination. When you look at a company very closely, you feel like you have an edge following a company, and you see a pattern like this, it means that you have a pretty good chance of really beating the market with this name. And that white line is basically showing you, that's a percentage yield figure. It's basically showing that the more that, even as AES has increased its dividend by a pretty phenomenal amount, from basically 0 to nearly 50 cents a share over the last few years, the share price hasn't budged. The yield, the percentage yield, is pretty much keeping pace with the dividend. So the more the dividend's been raised, it's simply raising the yield on the current price. Well, again, that's not a trend that's going to go on forever. It can only end one of two ways. One would be simply the dividend growth halts, and that's the bet you're making when you buy this stock. Dividend growth continues, because if that's the case, then you are going to see the price of the stock eventually start moving, and that yield will come down. So again, I think a fairly extraordinary value here in the market. So, and even if that I would strongly encourage people to take a look at it. Of course, I think the information we provide in Conrad's Utility Investor is a great way to keep up with this name and an investment in this name. But it's again one that I think is a solid bargain in this coverage universe. So I want to this last slide basically is our offer to you. I think we'll have questions here. If for some reason we don't, your question doesn't get answered as we go along here, I would encourage you to write it in, and you can also contact us there, calling Sherry. The promo code here for this is special $3.99. Our offer is a year subscription of Conrad's Utility Investor for $399 a year, and that's going to be $100 off our regular membership rate. It is a risk-free trial, so you can subscribe. If you don't like what you're getting, you can cancel after 30 days and get your subscription back. And that's pretty much it. It's very straightforward. Again, you can go to that website on the slide there for more information. There's a landing page, and also I can add into you Conrad'sUtilityInvestor.com. If you type in utility/outlook/218, that'll take you to a landing page. So that pretty much sums up the slides that I have. I'm going to try to get us on to the Q&A mode here, and I see that I think we have a few questions here already, and I'll just start taking them one at a time. First one here is, how does a Fed rate affect the economy? Fed rate increase affect the economy? What sectors, and could you give an example? Well, I mean, the funny thing about this is that, if you look at all these different stock groups that pay dividends, what jumps out at you, if you look at annual returns, is that investors do tend to panic a little bit when there's the first of the interest rate rise. But if you look back at, after a period of reflection, I suppose, the buyers do come back in. And if you compare returns on utility stocks, on MLPs, on real estate investment trusts, all these various things, you compare those to what happens with, what happened with interest rates over a given year, like what happened with particularly the benchmark 10-year Treasury note yield. That's that's where the correlation really breaks down, because if you look at the worst year for all these dividend-paying stock groups over the last 10 or the last 20, it is by far 2008, and that was a year where the 10-year Treasury note yield actually dropped in half. So not a whole lot of correlation there. In fact, fairly negative correlation. But you look at the following year, a good year for all these dividend-paying stock groups, and also a year where the 10-year Treasury note yield rose by about 70%. Now, not 70 percentage points, but the increase in the yield was about 70%. So, and it wound up, it ended the year at about 3% from a low of around 1.5. So, again, not a very good indicator there either. And the reason is that in 2008, the economy was doing bad. And so therefore all the stocks in the stock market did bad, including these dividend paying groups. They didn't benefit from a lower benchmark interest rate. They actually suffered because of what was happening in the economy. Then you got to 2009, the opposite occurred. You had recovery for the economy, recovery for the stocks, and interest rates went up. So that's one thing to consider. Another thing to think about is that during various Federal Reserve rate cycles, and I've presented this information in Conrad's Utility Investor as well, but when the Fed has been raising interest rates, more often than not, utility stocks have actually rallied. So again, that's just simply comparing Dow Jones Utility Average performance with various Fed interest rate raising periods. The only exceptions were in the 70s. One of those periods was 71 to 74. That tightening cycle when the Fed, when we were talking about whip inflation now and so forth. That was a really bad year for stocks, though. It was also a bad year for the economy. So it wasn't just utility stocks that suffered. Conversely, at the end of the 70s, same kind of thing happened. So you've got basically, I think, a very broad misconception that Fed interest rate raises are necessarily bad for utility stocks as well as stocks of other dividend-paying groups. Now, what is affected by rising interest rates? Well, if you have rising interest rates do affect capital companies that spend a lot of capital, and that's because it gets more expensive to borrow. So that in and of itself, viewed in a vacuum, is a negative, but the key thing about borrowing rates is it depends on a couple. They really depend on, particularly for corporations, they really depend on the law of supply and demand. So if companies are demanding more capital than is available, that's when you have, that's really the primary thing when rates go up. When the opposite is true, when, say, the big pension funds and investors that have to buy a certain amount of bonds, when the supply is not out there, then the rates they're going to pay are going to be, the rates that companies are going to have to pay to sell their debt are going to be pretty low. And those are best measured by, well, you can measure by coupon rates, but it's also measured by what's called yield to maturity, which takes into account a bond's price and where it will mature and the amount of time to mature. So it's basically giving you an annual return on an existing bond, and that's also that's probably a better indication of how much debt is costing them. But one thing we've seen since the Fed started raising rates, which again, as I mentioned on that earlier slide, was back in December of 2015, is that corporate borrowing rates have remained pretty low. And I think that's, and particularly for utilities, and I think that's a function of the fact that companies, since the Enron debacle, have been systematically cutting debt and refinancing near-term maturing debt into a much better debt distribution where you don't have a lot of maturities in any particular year. And the maturities that you do have are well off in the future. And so by virtue of that, and not having a whole lot of refinancing needs, companies have been able to basically walk away when credit markets have tightened and then come back when they can sell their debt at lower prices. And that's really been the reality of the bond market. So, you ask what could be, what happens if the Fed keeps raising rates? Well, it really does depend on, the impact really does depend on, I think, more than anything else, how that affects supply and demand for corporate debt that's out there, or even for U.S. Treasury debt. It's really kind of two different things. And I think to the extent that the Fed action does pump up the economy or keeps and I think, again, we're not really talking about that right now. We're talking more about what they might do to slow things down if there's too much stimulus put into the economy, particularly by the tax bill. But if they slow things down to a large extent, then I think we could see slowdown in the economy and a higher cost of equity capital as the market starts coming down behind it. So, or in front of it, usually is actually a leading indicator. So, cost of capital will probably increase before the economy does start to slow. So those are factors, again, that we watch pretty closely. But that's the so-called kind of axiomatic swing when they raise interest rates doesn't really exist. Banks, of course, are very affected by interest rates, but again, it does come down to demand for credit. I mean, if there's not a lot of demand for credit out there, they're not going to be able to charge a lot for that credit. Supply and demand. A lot of people look at the interest rate environment and they just say, well, what's the Fed doing? Again, it's all about supply and demand. That's what will determine what corporate borrowing rates are. And corporate borrowing rates, of course, can have a big impact on earnings, but it is all relative. If a company can earn a 20%, if it's an environment where a company can earn a 20% return on a project that's safe, it doesn't matter so much if the price of if they have to borrow, if the borrowing rate's 5%, that's a much better situation than if project returns are only around 5% and borrowing rates are down to 1 or 2%. So again, a lot to throw at you there, but I don't think that that's going to be I think again, Fed action as it affects the economy is the important thing to focus on, rather than what sectors might or might not be affected by the Fed. And always the most vulnerable companies in the cycle are going to be the highly indebted ones. And that is actually a pretty good segue into the next question, which concerns the tax bill. One of the things concerning corporations is the deduction of debt interest, and that's going to be about 30% of what's called EBITDA, earnings before interest, taxes, depreciation, and amortization. If a company is spending more than 30% of EBITDA in debt interest expense, it's not going to be able to deduct that off their taxes. So that you can see right away that's bad news for very heavily indebted companies. It's kind of adding insult to injury as well, but it's a good reason why you want to avoid high debt companies, and those are going to be, of course, something we're going to be looking at very closely in the report that we'll be sending out to readers in the utility roundup. The So that other question regarding tax reform was that concerning the first in, first out, and that is the word. The question he's asking is the first in, first out in the tax bill no longer in the legislation. That is the word. That it is not in there for individuals. It wasn't going to be in there for institutions in any case, but the word is that you will be able to continue selling the shares that you want to sell rather than abide by the formula, the first ones you buy are the first ones you sell, which really conveyed a lot of very discouraging for individual investors. But that was actually taken out. So, yeah, hooray for whoever was behind that, but getting that out of there. But that definitely decomplicates things. Again, we don't know for sure what's actually in there until there's actually legislation, until it's actually passed. That's one reason we've held off on doing a full-on report. But that does seem to be something that's left out of the that was left out of the bill that's now going to be voted on. So next question here is: with all the boomers retiring, where is all the pension money coming from? Well, it's there's first of all a fairly big pool of it there, and it's going increasingly into these passively managed funds, and into, in other words, funds that are run on algorithm that own a whole bunch of different indexes. And when you buy, you say, well, you're retiring and this, or if you've already retired, they simply shift a whole bunch of your money into bond ETFs from or exchange traded funds from stock funds. And these algorithms are pretty complicated. They're there's certainly very knowledgeable people writing them. One of the problems with them, though, is that a lot of them are seem to be constructed along the same lines, so we don't really know how they're going to respond in various crises. We got a little taste of it, unfortunately, and hopefully not too much of it is a real taste. But from these flash crashes where we've seen these massive down moves in these stocks that really don't deserve to be pushed around that way, but that's kind of a consequence of it. That's that's where this that's more or less where a lot of this money is coming from. I think a lot of people are seeing it more. You're seeing it more concentrated because a lot of people have kind of given up doing their own investing, and they're instead relying on let George do it, more or less, or let as the old saying goes, let Vanguard do it. Let these let HAL, I guess, if you use the computer in 2001: A Space Odyssey. But there's a lot we don't really know about what's going on. I think, the economy being stronger and people maybe putting more money into funds and that sort of thing, generally a good thing. That's kind of where some of that money's coming from. Some of that money's coming from overseas, because the U.S. dollar is still the currency of record. That's and the U.S. economy and so on are still kind of the standard around the world. Still the most liquid place. Still the place where you can foreign non-U.S. citizens can invest in with the most assurance that a government's not going to come along and seize their assets, or or the rules of the game will change pretty radically. Although, again, the tax reform and many of the things that we're seeing now are could argue against that. But generally, we are a country that doesn't impose that regulation on capital, that degree of regulation on capital that other countries do, and that means that money does get parked here, and particularly when the global economy comes along, grows, that happens as well. So those are some reasons why there's a lot of money coming in, but I think it will continue to flow as long as the good times roll. When the good times stop rolling, then again, that's why we're preparing ourselves with our 3-part portfolio guidance plan. So I got a question here. What do I consider the next the best in class telecom? The the best in class telecom in the United States. I've kind of recommended more or less a two or three company strategy when it comes to telecom, and they are the biggest one there: AT&T, Verizon, and Comcast. And we've been looking at Comcast as a buy for a while. We've had a buy target on it at 35, and it's stubbornly remained above that price. We thought that perhaps when we started seeing some of the statements coming out from the White House and so on, that it would that we could see a drop in that stock, particularly some of the comments made about licenses and so forth. But that hasn't happened. We got it got below that price just barely for a short time, but it never really stayed there. So we still don't consider ourselves in it in the portfolio, but we would definitely add that name. So those three names, what do they have in common? Well, they generate a lot of free cash flow after spending a lot more on network than anybody else in the business does. And that means they're always ahead of the game when it comes to network. And we've just seen a massive build out of 4G wireless, which really accrued a lot of customers to them, and thereby a lot more a greater share of industry revenue. They are now on the verge of launching, going into 5G communications, which now seems like it's going to happen much faster than many people thought. And that will really represent a massive increase in capability in both the consumer market, where it makes the paid entertainment, it really takes that to a totally different level. The ability to download movies in a second, and so on. A lot of potential there, and particularly with the millennial market becoming larger and able to afford services. I mean, this is definitely where things are going. Is massive demand for this. But then also on the machine-to-machine communications, the Internet of Things, as it's called, that we've written quite a bit about. It being able to spend the money to get things like massive MIMO, like small cells, deploy big networks of all these types of things, adopt these new technologies. And 5G depends on 5 technologies, and that means you've got to have capability in all of them in order to be able to do things like reduce latency and so forth. A lot of the Internet of Things is just going to be basic sensors communicating with other sensors, so it won't ever make it to the larger internet. But certainly, the 5G communications is going to open up a lot of doors, and we did a report on that for readers as well earlier in the year. But those 3 names simply have the ability to finance. They also pay dividends, which the other players in their industry increasingly do not. And I think we continue to see the same thing we've seen the last 20 years. In fact, if you looked at, if anyone who might remember my book, Power Hungry: Strategic Investing in Telecommunications, Utilities, and Other Essential Services, which I wrote, it's getting pretty close to 20 years ago, I guess about 18 years ago. But that was one of my things in there, just pointing out that the companies that had the cash flows, had the balance sheets, were eventually going to be the winners in this competitive race. And I used to cover at that time about 60 different U.S. telecoms. Right now we're down to about 15 viable companies, and many of those I think will probably go by the boards over the next several years. Just a lot of consolidation, not all good. Back in the 90s, the consolidation was all about these nice high dollar mergers. The consolidation in the years since the tech wreck has been basically just zombie companies going away and never coming back. And some of the zombies have been quite large entities. Everybody remembers WorldCom, MCI, and so on. But it looks like Sprint may join those ranks at some point here going forward. They're just unable to keep up on network. Even if they borrow a lot of money, which is now costing more and more deep junk ratings. T-Mobile USA is a potential exception to the rule. They've kind of poked their way up through, but keep in mind that they are basically the arm of Deutsche Telekom in the United States. So they're not really a small company, and whatever happens to them is going to be what benefits Deutsche Telekom the most. Right now, they're in kind of a growth phase. We may see them pay a dividend at some point, but they're definitely and they're interesting, and they're definitely one we cover. But the best in class goes to the larger names. What are your thoughts on EPD, which is Enterprise Products Partners? And we don't cover a lot of MLPs in Conrad's Utility Investor, but we do cover a handful, and they're primarily the big names. And Enterprise Products Partners is one of them. So that has been one since the beginning, since it was Gulfstream, really since it was the old El Paso Energy Partners. Adjunct to that El Paso Energy, which went through some pretty hard times about 20 years ago, and that was one of their unit became Gulfstream, and then it later merged into Enterprise Products Partners. So we've covered this outfit for quite some time. It is the best in class, arguably, master limited partnership in the U.S. As well as U.S. midstream company. I think you can make a pretty good case for that. They've consistently been ahead of the curve. They now have infrastructure that is very much used and useful regarding exports of U.S. Crude oil and U.S. Natural gas liquids like propane and so forth. They've been ahead of the game in almost every way. And this question concerns my thoughts about them converting one of their natural gas liquids pipelines to transporting crude out of the Permian Basin, which is, of course, one of the biggest areas of the country for, if not the world, for oil. My co-editor at Energy and Income Advisor, which I mentioned is a sister advisory to Conrad's Utility Investor. He and I went out to a conference earlier this year, which was focused on the Permian Basin, and so you had there were a few analysts there. There were more industry people there, and it was a great opportunity to really. It was conducted by a company called Hart, and a great opportunity to go out and really learn a lot that you won't pick up in numbers and so forth. And it's really informed, I think, a lot of the decisions we've made on MLPs as well as related companies to those MLPs. We did a report for Energy and Income Advisor readers, and but like I say, it's informed decisions on some of the names in Conrad's Utility Investor where we covered MLPs. This is really an area that has gotten a lot of excitement, and valuations have risen, particularly amongst a lot of the producers. They dropped off fairly sharply middle of this year, but companies like Enterprise that are providing transportation capacity for energy, and there's a lot coming out of there because there's a lot of drilling going on, are really in the catbird seat. And Enterprise, by converting this pipeline to crude oil, I think will dramatically increase its margins on this particular asset. They can, of course, utilize, and shippers that utilize this pipeline can, of course, utilize a lot of their other assets that are in the Gulf region. So this looks like this company doesn't make stupid moves as a rule, and I don't think this is one either. They definitely know what they're doing. I mean, you can say lower natural gas liquids volumes for EPD other assets because they do have a number that service that instead of crude oil, but there are other sources of NGLs. Another area that we've talked a lot about is the SCOOP stack. In central Oklahoma, we've also talked about the Haynesville Shale, which are also in that part of the country. So there are definitely other sources of NGLs in regions that are really ramping up demand. And however you slice it, crude oil is a higher margin product than some of these NGLs. So this is definitely a positive. I don't think it's something to be worried about. The one thing I think has happened at EPD that I do think bears comment on, and it's actually a good thing if you're someone who's holding this thing for the long term, and that is that they've decided to slow down their rate of distribution growth in order to cover more of their capital spending with operating cash flow. It kind of makes it EPD a little bit more utility-like. So from the standpoint of Conrad's utility investor, conservative returns, I think it makes me more comfortable holding this name. I think one thing that we did see out of the tax bill that we'll be commenting on, I can just briefly mention right now that's a positive for EPD, is that it didn't seem to take away many of the tax advantages of MLPs, even though that corporate tax rate came down. And EPD, I think, is a name that could do very, very well, whether they're organized as a C Corp, corporation, or as an MLP. I think the main thing that would hold them back from making that conversion would be the shareholders, the unit holders, the impact on them. So, and because if they did make that move, which would be pretty much the same thing Kinder did a few years ago, Kinder Morgan, when they bought in the MLP unit, or the same thing that One Oak did with One Oak Partners. Some of these deals, that there would be a tax to consequence. The Kinder deal, though, that only turned sour after the deal finally went through. They'd make a really good offer for shareholders or unit holders of Kinder Morgan Energy Partners in order to cover some of that tax. So, and in most cases, it covered the extra offer did cover the vast majority of, or if not all of, that tax. So I think if they did do something like that, they would. If they did make a conversion to C Corp, they'd do something like that. Just something to keep in mind with that name. But I do, this particular move, I think, makes a lot of sense for them, converting that pipeline. And this is a name that we are comfortable with holding. What's your forecast for SCANA? Should an investor sell now, or do you think it will be acquired by Dominion or NextEra Energy? To that list, I guess you could also a potential acquirers for SCANA. And I had a slide on that regarding the value of differentiating Southern and SCANA as nuclear developers earlier this year. Dominion, NextEra Energy, you could add, of course, Southern to that list. Duke Energy would be another name that's talked about. They're all pretty proximate to SCANA. They all have kind of similar utility businesses. They're all Southern electric companies with other assets. And I think that's probably what's going to happen to SCANA. I think SCANA, the stock, while you would definitely been better off out of it for most of this year, I think at this point we've kind of hit a bottom in it, which is, it's kind of going out a little bit aggressive to say, because there are unanswered questions about what they're going to have to eat in terms of nuclear plant costs. But they are right now about 1x book value. And, if you say compare it to some of these other utilities that are 1.7, in that neighborhood times book, it's clearly been discounted for a rather large write-off. What happens in the interim to it if they do make that write-off? Dividend cut is possible, and so on. And that's really the risk for holding on for a merger. But it looks to me like if they have, some sort of decent regulatory settlement that's approved by regulators and is bought into by the legislature and so forth, and it looks like there are makings of that. It looks like that it's stopped going down, and it will operate. That stock is going to trade very differently from, say, the utility average uh, if and when utilities run out of gas on the upside, which I think is actually, in terms of the big cap average, I think is a pretty major risk here in 2018, just because of the high level of expectations. But SCANA has become kind of a different type of play. So I'm not ready to recommend it to you right now as a buy, but I do think, one, it will be acquired. I do think, two, odds now are favoring that we have hit some sort of bottom, at least the neighborhood of a bottom, that when whatever is finally agreed to, will not be an event that will take it down appreciably below where we are now in stock. So again, this is one I'm going to really look at in pretty close detail for the January issue in terms of what to do now. It has been a sell in the issue pretty consistently in CUI, like I said, for some time. But I think we are getting to the point where we will have different advice on that, at least a hold and quite possibly a buy. So again, good question there, and one that it's definitely an interesting area of the market, and a pretty good, I guess, example of why we want to be very flexible in this environment. Probably more flexible than we're used to being with our utilities. My favorite holding period for good utilities is forever. I mentioned the dividend reinvestment plan. Some of those names I've held 25, as much as 30 years. And have never regretted it, but I've definitely ridden up and ridden down a lot of catastrophes, including the Enron disaster, where it's kind of hard to remember now, but looking back at even stocks like Dominion really getting their heads handed to them because of what was going on in the sector. So I've had to basically just hold on throughout that whole period and be steeled to do that, and I'm willing to do that with. I was more willing to do it back then because I had a much longer time horizon in terms of investing and needing the money or wanting to use the money for something. And to tell you the truth, I'm probably just going to hold a lot of these things, keep holding a lot of these things, though. But the other part of that is that again, we have had this extremely profitable, extremely rewarding bull market, and valuations are pretty high. So when stocks are high, we want to be on the alert, taking profits and so forth, like I mentioned. And when they come down, like SCANA has, and really reach a bear market valuation, for one reason or another, we want to take a strong look at deploying capital there, because again, when things do turn around the other way, those names that have already come down, that are still solid on the inside. That doesn't apply to every company that's come down. Certainly, some of them we just want to stay away from. But business weakness, that's what we have to make our judgment on. That's how we have to differentiate. And again, like I say with SCANA, I think we're getting pretty close there to having a different opinion. Price does make a difference. Okay, so the next question here is the tax reduction for corporations. I thought it would allow those companies who paid a lot of tax now have cash to pay down debt owed. So would an investor consider paying attention to this as part of a valuation of a company? I think that's a very good point. I think, another way of putting it would be that simply companies that are already strong are probably going to get stronger from this because they're going to be paying, less tax. Of course, it varies across the spectrum in terms of who is who's able to pay, who's paying what, and who's what sort of rates they already pay. A number of U.S. companies don't really pay much in the way of tax, and that actually applies to some of the companies in our coverage universe. They haven't been paying a 20% annual rate for quite some time, if they ever did. So, let alone anything that is close to the previous statutory rate. So they're it's debatable how much they get out of tax reform. I do know one company that will benefit quite a bit and could follow the lines along what you're suggesting is AT&T, because they have been paying a very high tax rate. They do have quite a bit of debt out there, and while interest is not anything close to 30% of EBITDA, they can probably benefit from paying down some more of their debt and using some of that cash flow to do that. So that's another big point. I think another kind of side point to what you're saying here as well is that to the extent that these stronger companies that do have cash flow to pay down debt, they will have I think a pretty strong benefit in that the supply of their debt on the market is going to become much tighter. And that means that these pension funds that have to go out and so forth, that have to go out and buy bonds, are going to find a potential shortage. So that, again, another point in the favor of the suppliers, of the sellers of debt as opposed to the buyers of bonds, in that, and another argument that no matter what the Fed does, you might actually see an increase or rather a decrease in corporate borrowing rates because of it, simply because of the scarcity. Just one last point on this: if you're talking about weaker companies saving in tax rates and being able to deploy the saved taxes for paying down debt, I don't think there are a lot of names that would fall into that category, simply because the reason companies tend to have a lot of debt is that they're not earning as much as they could be. They don't have the cash flow, the free cash flow. So I'm not really sure how much this benefits owners of junk or issuers of sub-investment grade rated debt or junk bonds. I mean, it's an interesting point, and it's something to definitely look at through the coverage universe. If lower tax rates do present an opportunity for some companies to bring their debt down, but for the most part, the companies that do have these high levels of debt aren't really paying a lot in taxes. And in fact, the key question is, is their effective tax rate actually going to go up because they don't have the benefit of those deductions? So very much a matter of differentiation. We'll have a lot of this analysis in the report that we'll be doing again after this tax bill passes, and as we'll be focusing very closely on how our companies are affected. When we do the January issue as well, you can expect to see a fair amount of that kind of analysis in the comments. That will be an issue where we're going to focus on quality grades, so and how companies measure up in terms of quality grades. So should be a pretty good way to get to know companies that you own already or are thinking about buying. And of course, we will have our top recommendations in that. So let's see. Another question here is, let's see, about MLPs. A tax bill giving corporations a lower tax, and the bill included a lower tax for unit holders of an MLP. Is this in the bill? Basically what I think what this is concerned with is treatment of, or could be concerned with treatment of pass-through entities. MLPs are definitely pass-through entities. That means that they don't pay corporate tax, but rather individuals pay whatever the equivalent tax is. It flows right through, the income flows through. So it's not double taxed, and that's been considered a major advantage of MLPs and so forth. In addition to the return of capital dividends, which aren't really a return of wealth, it's just how various dividends are classified for tax purposes. I think there's definitely this is the final bill. What's in the bill has been crafted in such a way that it doesn't negatively impact the attractiveness of MLPs, particularly to higher income, higher net worth, higher income individuals. It still preserves most those factors. What might be different is how would-be issuers or would-be MLPs themselves view the tax changes versus their tax status as MLPs. So are we going to get conversions to C Corps out of this, in other words? And what will be the impact on the MLPs when we do, if and when we do get those conversions to C Corps? And again, this is something we're just going to have to explore. I don't think it's 100% clear. I think it is going to, how it affects each individual MLP. I think we're just going to have to look at them individually. But there certainly shouldn't be a disincentive for owning MLPs coming out of this tax. The tax bill, and they actually did a very good job. The NAPTP, or actually it's now the MLPA, the primary lobbying organization for MLPs. They did a very good job of having their interests heard and getting the language they wanted into the bill. You can go to the MLPA website and find out a little bit more about their views on it. But we definitely take at least a good part of our cue from what they've been reporting there. And just like those Edison guys, Edison Electric Institute guys, back in November, were pretty bullish on the tax bill, and seems to be borne out. It looks like the MLPs are feeling the same. So that's typically a good sign. And again, we'll have more details in the report that we had. The offer is $3.99. Is this good to the end of December? Yeah, I'll say yes. I think again, you want to make sure you have that promo code special $3.99. But if you did subscribe now, as opposed to, your 30-day window would still continue. For the issue coming out, for the chat. So you would have a good, whether you did it now or waited till the end of the month. I think you would still have a pretty good sample size to see if Conrad's Utility Investor is for you. As you do so, I would just encourage you to go to the site as well and check out the features we have there. Check out the special reports that we've done. You can actually look at EEI 51 and EEI 52, the audio visual there, just by scrolling back a little bit. You can check out the coverage universe. You can check out the portfolio, the live portfolios, all the alerts we've done that I've talked about. You can sort of take a look at the reasoning in those, and why we did what we did. I think you can get a pretty good, and you can actually go back and look at every single issue that we've ever done. I think that's all a worthwhile endeavor. I think I'm pretty confident that if you do that, you'll see a lot of things to like about the issue, and you'll want to be with us for a full year. I do think it will be quite a profitable year if we're active, like I say, if a little bit more active than we might be at the beginning of a bull market. I think it'll be a time where if you do own a lot of utilities, you're going to want to make sure you kind of sift through and weed out the weaklings while making hay while the sun shines. Again, joining us will give you the ability to go there and do all that. And I think I'm pretty confident you'll like what you see. I'm not seeing a whole lot of new questions. I think I might. I'll give whoever wants a chance to ask a couple more if you want. I've got basically I can. One of the other things that with this service is that we do get a fair amount of email from readers, and in addition to the chat, I do try to answer those. I do try to answer those questions, and when I receive them. So I'm just going to give you, for instance, of the kind of questions that I do get. And again, if anyone thinks of anything they're more interested in, I'll be happy to go on. I had a question. I did do some research on what's called ESG, environmental, social, and governance ratings that are put out by investment service that we use that pretty much has everything under the sun, Bloomberg investment service. So this question concerned that ESG has is viewed by different investors in different ways, but I just wanted to kind of mention this a little bit, and why I thought it, in my answer to the question, why I thought it was important. Basically, basically what this type of thing does, I mean, it's part of this socially responsible investing, SRI, kind of tied in with that. And what various rating services will do is look at a number of criteria and rate companies based on institutions, based on how they stack up. And in the case of ESG, it's environmental, social, which is basically a lot of workplace criteria, and then governance. And so the question I got was, isn't a lot of this just not really it's more politically focused and, quantitatively, qualitatively investment focused? And, my answer to that is, and why indeed would you analyze, research this? And my answer was basically three things. One, utilities depend on a low cost of capital, and a lot of capital is being invested in SRI and so forth. And you're also, the converse of that is that you're seeing a lot of money that's being pulled away from companies that don't tend to rate very well on these various environmental, social, and governance criteria. So it's important from that standpoint as a sort of a future thing to look at in the future, because eventually cost of capital will be more expensive for utilities. We have market cycles, and even though these companies have done a really good job of stretching out maturities and eliminating refinancing risk and so forth, they do depend on capital markets. So eventually every edge that you can get will be a good one. And we've already seen some companies doing this in terms of doing things like issuing green bonds and so forth. Again, I think it's something to look at, and I think it's important from that point of view. And we are seeing more money put in that area, and as well as seeing companies like Norway divesting from coal-fired utilities, for example. So, what does Norway matter? Well, maybe not a whole lot right now, but it might matter at some point when there's a lot of capital that's needed for something. So, very interesting from that perspective. Another perspective is simply the fact that utility workforces are turning over, and this is a question that or a subject that I encountered very frequently at the Edison Electric Institute meeting that I've mentioned several times, the 52nd annual financial conference. Very much on the minds of a lot of companies was the fact that a lot of people are retiring, and the companies are digitizing. So they're becoming more data intensive and less labor intensive, and the kind of labor and employees that they need are people who are conversant in a lot of things that are different from what their former employees were. And so they're competing with technology companies. They're competing with companies like Google to get the best people so they can digitize their business, which there's an enormous, and we've done work on this also in CUI, there's an enormous profit potential here from companies basically utilizing more data. Just to give you an example, tapping the data from a power plant. They now tap about 2% of the data from a power plant. If you can up that significantly, you can do things like preventive maintenance. You can forecast when a particular part is going to run out or wear out in a facility, and you can make your replacements much more efficiently. You can tell where power losses are taking place in the grid, what needs to be replaced, respond to things much faster. All these things that cut costs, improve service, and by extension, boost the bottom line for utilities. So there's a tremendous, people were talking about a $2 or $3 trillion opportunity for the industry. But to get that done, you need to have the best employees, and that's that will be important for the kind of employees you're going to get to come in fairly decently on ESG. I think maybe not so, that's kind of a longer term thing, perhaps, but you can already see how companies that have, like NextEra, just comparing NextEra Energy to First Energy, for example, NextEra being the largest, it's a utility serving South Florida, but they're also the largest producer of solar and wind, have a much better corporate image than First Energy, which is trying to get a federal subsidy for coal and its nuclear plants, which are unable to run profitably. So it's not hard to see which company will be more inspirational to, and again, I'm stereotyping, but to the kind of workers who are needed to move this technological revolution forward, the kind of people who might feel better about working for Google than the local utility. So it's important for that reason. And then finally, just from the governance side, some things that I found out there, people who are directors not showing up for meetings. I'm a director of an independent director of a fund group. It's essential. If you don't show up for the meetings, it's kind of a tacit admission that nothing's going on there, and that oversight is not really a priority one. So, these are the kinds of things that this type of analysis shows us. How fast employee turnover is occurring. Which again is, could be evidence of things not running very well, and an early warning of that. So it's just another tool in the toolbox. I believe that you want to keep your politics out of investing for the most part, at least if you want to be effective. There are others who disagree with me, and there are plenty of people who say that ESG and SRI investing outperforms the market. I think it depends very much on who the manager is, but from our purposes, there are factors that this type of analysis shows us that can really improve, I think, our overall analysis and give us an edge. So that's why we're looking into it. So that long-winded answer did give you guys a chance to put a few more questions up here. One is AQN is shown in the conservative income portfolio as a buy. So you are obviously looking at the issue of Conrad's utility investor, and that is actually the case. This is one of the names, like I mentioned during this talk, one of the names that did come out of the 51st Edison Electric Institute conference, but I also re-upped the recommendation in after EEI 52. They were once again one of the more impressive companies there, and one reason was a deal that they did, which was with a company called Abengoa SA that kind of establishes them as the financial partner of the Spanish engineering company that really hit a rough patch, got over their skis, in the words of the Algonquin CEO, when they started expanding. And Algonquin gets a large minority stake in basically a controlling interest in Atlantica Yield, which is a yieldco that was related to Abengoa. It gets a partnership with Abengoa SA, and I think this will have a tremendous opportunity to really juice up earnings in years going forward by investing in places where they wouldn't necessarily invest. Markets that Algonquin, a Canadian company, is aware of as a developer, but as a company that's been purely in North America to date, has not really invested in. And it's a low risk way for them to make that investment, making that investment basically through Atlantica. So I think that's a very positive thing for Algonquin. They've also proven themselves, their ability to execute, and they've announced a couple of other utility acquisitions of smaller systems that people wanted to get rid of. So a lot of good things happening there. 10% annual dividend growth being definitely not the least of them. And I think again, Algonquin is one of our top names going forward. We do have it as a buy. But we do also have it as a buy below a certain price, which is $11 a share. So we want to be opportunistic with this name, just as we are with other names. We don't want to chase any companies beyond points where we think that they're good values, and that's what you'll find pretty much for every stock that we cover, and particularly portfolio names. I do in every portfolio update. I list the companies that are trading above buy targets and what to do with them. Whether should we take profits on them? Where they stand with us. That's become a very important part of the analysis, and particularly as we've gotten to this point in the market where you have valuations so high, and when they're punctured for one reason or another, you get buying opportunities. So we really want to be opportunistic in that area, and that's I think a really important distinction. So that is Algonquin. There was one more follow-up question on Algonquin from the same listener, talking about the Energy and Income Advisor newsletter and where we had rated and where we actually had dropped Algonquin from one of the portfolios there. And I'll just again reiterate what we said to what we told readers there. Algonquin, when we originally put it in the Energy and Income Advisor portfolio and in the international portfolio, which we have 3 portfolios in that publication as well. Maybe some of you are subscribers to that already, but the international portfolio is where Algonquin had been. When we originally put the portfolio together and Algonquin was a charter member, it was far more of a independent power producer. So it was much more in the contract generation business than it was in it was a regulated utility. It also was much more focused in Canada at that time. And as I mentioned, with the Empire District merger and some of the other things they've done, they're much more a US dollar play. So they're like over 90% of their cash flow is now in US dollars. And that will continue with this, that will increase actually with this Abengoa Atlantica deal. So, again, a company that has, over 95% of its revenue coming outside or coming from the United States really doesn't belong in an international portfolio. So that's kind of why we made the change in that publication. And it does remain a Conrad's utility investor recommendation because it is a utility. So kind of a little housekeeping there, I guess, more maybe a little inside baseball why we moved it around, but we didn't think it was appropriate to be in an international portfolio any longer. We did replace it with another company, an Energy and Income Advisor. And those of you who are EIA readers hopefully have a chance to check it out. A company called Northern Power. And that's in the portfolio now, and more or less in its place. But that was the reason for that deal. I hopefully we did explain that in the newsletter. It's not a matter of a stock being good or bad. It's just because it not belonging in an international portfolio that is non-U.S. names with basically being a U.S. name. With again 95% plus of cash flow coming from being in U.S. dollars. Atlantica's cash flow is mostly in U.S. dollars, even though they do have assets outside the United States, and that's because of the nature of their contracts. So hopefully that answered that question. And that I can understand why that would appear to be a discrepancy, but it's more or less just kind of differentiating between the different portfolios we have at the different advisories. So let's look at a couple more questions here. CTL, which is CenturyLink, comments on that one. So this is one of those wireline telecoms. They have, of course, been facing some pretty severe headwinds in recent years as people have cut the cord and as competition for broadband has really kicked up particularly from cable television companies that frankly have better balance sheets than CenturyLink. Companies like Comcast, for example. They've also seen competition from wireless companies as well. It's been pretty much uphill for CenturyLink. Now, we did try to do a trade, and I'll just talk about another one of our services, which is pig versus bear. And we did a trade in CenturyLink where we recommended the stock, and we simultaneously sold a put option. Put option gives you the right to sell a stock at a certain price by a certain date. Selling a put option gives somebody else that right. But if a stock does hold in place, the value of that put option, if it's is going to lose value. And we looked at one that's called out of the money. So in other words, the strike price was above where the current price was at the time, and we were able to sell it therefore for a pretty nice premium. That one, it actually worked out pretty well as a trade because we were able to, by utilizing stops, to get out of the stock, and the put option happened to expire worthless. The stock since then has taken another huge drop. So again, another good value if you're trading of using stops. CenturyLink and Conrad Utility Investor has been pretty much a consistent sell for a while. And again, that's because mainly they have declining revenue. They've been unable to arrest the declining revenue. I think that will probably change. And I think they will, at this point, stock seems to be pricing in pretty much a lot of bad news, including a potential dividend cut. The salvation of the company was the merger with Level 3 Communications, and this is a deal that we reported on pretty extensively in CUI, but it does change the revenue mix for CenturyLink. I'll just add our fourth product to the discussion here, which is deep dive investing. I did a piece on a video presentation on junk bonds. We do have a bonds portfolio in Conrad's Utility Investor that we do report on periodically. It's gotten pretty hard to find bonds, frankly, that are bargains. But I think one area of the coverage universe where the bonds are kind of interesting, again, was something that I did talk about in that deep dive, and that is, bonds like CenturyLink that do have a clear path for recovery. And we will have a feature on bonds probably in the early part of the year. We'll update that bond portfolio and probably add a few new names as well. But those are my comments on CTL. I do cover it in the coverage unit. It's in the coverage universe. The comments are quite extensive on all the companies there. So I really urge everybody to take a look at those. The most recent ones in the most recent issue, there are a lot of it's concerning the ESG, but this next issue we'll talk a lot about quality grades. So, if you do join us, you'll get that. You'll see what kind of the inside of what makes our ratings, a lot of information to help you. And then the following month will be earnings. So we'll look at the next quarter earnings. You can also go archive the issues online, the November issue, which did have earnings updates for all and extensive commentary for all the companies in the coverage universe. So there you go. CenturyLink's in the coverage universe, and we do cover it on a regular basis. Your outlook on PPL and FTS. Okay, and these are also both in the coverage universe. PPL Corporation is a utility that is kind of split between the UK and the US. The UK part has kind of scared me, frankly, over the past year or so. One, because of questions about the currency. We've already seen a pretty big drop in the British pound regards to Brexit. And now, of course, there's still quite a bit of uncertainty as to how that's going to play out. So that's one worry. The other worry is just that the country, the government there, the May government has said a lot of, has kind of become quasi-populist, I guess, which is always a bad thing for utilities. The Labour Party opposition is far worse for utilities. Again, I'm talking about from a utilities point of view. I'm not making a political comment. But it's definitely been a tough time to be utility there. It could get a lot tougher. In fact, we could see some renationalization. I just don't really want to have any parts of it at this point in time. I think there's just too much uncertainty. So PPL, I think, is just a name to steer clear of right now. It's certainly pricing in it has a much lower valuation than the typical utility, but again, quite concerned about what might happen in the UK, and just you don't really want to. And again, not a political commentary. It's just simple facts that governments often like to take a bite out of the utilities. They're a very utility bashing is a fine old time honored political pastime, and when you have a company that's in danger of falling into that trap, you really want to steer clear. FTS Fortis, which is a Canadian company, it's made made acquisitions in the U.S. I think the only concern there is a high valuation, so it's trading above our buy target. But it's definitely its acquisitions have been paying off. A very impressive presentation at the Edison Electric Institute meeting, and I'd like to wait for a lower valuation for that one. Could you please compare Enbridge with Enbridge Inc. with TransCanada Corporation and Pembina Pipeline? Tell me which one is best for long-term investing. Well, I think these are the three largest midstream companies in Canada. So I've covered them for a long time in several different advisories, I guess you could say, over a long period of time. Of those three right now, I think Pembina is the one that has the most together and the least political risk. And they just made a merger with a company called Veresen to become the #3 Canadian midstream company. That's where most of their assets are. They do have a couple of projects that could really be blue sky for them since they made this Veresen deal, which one of which is expanding the Alliance pipeline, which brings raw gas from Alberta into the upper Midwest. Very promising project there. They also have a potential propane export facility or actually it's a liquefied natural gas export facility in Oregon that they're attempting to build. So if they get any of those going, I think that would be a huge mover to earnings. But what impressed me most about them is just their ability to get things done and execute on projects, and which they continue to do with truly blue chip clients. So I really like that name. I think you do want to watch the price. It was recently above our buy target. TransCanada. I think the real gemstone here, or the real gem of information here, is that they don't really need the Keystone XL pipeline to realize some pretty outstanding growth, 8 to 10% dividend growth over the next 5 years. They don't need to build Keystone to get that done because they have a lot of other projects that are lining up and are in very good shape to do. Enbridge is kind of the odd man out of that, and that's one that I would just be a little bit careful of. They will run them. If you own any other part of that enterprise, Enbridge Energy Partners being one, Spectra Energy Partners, Enbridge Income Fund, if you own any of those other parts, your interest is being run subordinate to Enbridge Corporation. So they're the best part of that family to own. Unfortunately, you just get the feeling with that one that there's a lot of, and particularly they just walk back their guidance as well, sort of a tacit admission that they just have a lot of parts out there that it's difficult to integrate. So again, that's my analysis of those. I guess we do have TransCanada and Pembina in our portfolio. Enbridge we have in our coverage universe as well. EIA speaks about, next question, about a prospective sharp rise in oil and how will this affect the utility universe? Overall, not much because basically utilities don't use oil to any appreciable extent anymore. Even Hawaiian Electric, which was one that used it for a long time, Florida Power and Light, they are definitely transitioning off. It's the highest cost way to generate electricity. So I think it kind of boils down to sort of niche opportunities. I mentioned IEnova earlier on and Sempra. Mexico does rely a lot on fuel oil to generate electricity. So to the extent that the price of oil goes up and it becomes more expensive for them to generate electricity, I see a lot more projects there for IEnova and Sempra. But that's the kind of thing that this kind of large macro issue affects things. Obviously the utilities that serve energy intensive parts of the country, it's good news for them. It might actually, more oil production at higher prices could have the impact of more associated natural gas, which would drive down the cost of generating electricity using natural gas. Again, encouraging more gas building and more shutdown of coal. So again, that's a lot of things on the plate there, but those are, I think, pretty positive. I think overall, if you're looking for impacts, you have to look at individual companies and kind of differentiate. Would you steer clear of SRE due to the California fires, or is this one of the more fairly valued utilities? I wouldn't steer clear of it because of the California fires. I think that was kind of overstated. In fact, the California Public Utility Commission did say that they would that they would not be using the decision on the 2007 fire recovery as a model for any recovery filed from this series of fires 10 years later. That really does depend on, I think, whether somebody finds fault with utilities, and that seems like probably not going to happen this time, although a little bit speculative to make that call right now, but we really haven't seen anything to indicate that now. But is it one of the more fairly valued utilities? I don't think so. It's actually trading reasonably above. It's kind of more like an evaluation of NextEra Energy, which has really taken off, had been one of our favorites. We tried to get into both those names at a specified price. We did get into NextEra Energy, and that was a nice one to be riding up. Sempra never really got down to our price to add into the portfolio. It hadn't gone up as much as, nearly as much as NextEra Energy, but it hasn't gotten down to where we want to get in. Again, that's another differentiator, and you can, just as NextEra Energy Partners has been a better buy than NextEra over the past year, so has IEnova been a better buy than Sempra. I hope I didn't say Spectra. I meant to say Sempra, which is SRE, California Utility. Spectra, of course, is the Spectra Energy Partners is the unit of Enbridge, which is a little bit scary in and of itself, in that all the various management team left en masse after the acquisition of Spectra by Enbridge. But Sempra is a name that we would definitely add on a drop to our buy target. Well, that's all I have here, and I very much appreciate everybody tuning in today, and there was a lot of really good questions. I do see one more popped up here. AltaGas in the U.S. If you are an Energy and Income Advisor reader, you will read pretty much all you'll get another update on that one. I do think it is affected in, we do cover it in CUI in one respect, and that is that it's in the process of taking over a company we do cover, WGL Holdings, which is the natural gas distribution utility for the nation's capital and environs. And they are it's a fairly generous deal, but it's also a deal that I think has a lot of potential synergies. I think it will close. I think it not closing yet, and some of the regulatory proceedings have held AltaGas down. But I just looked at how much the dividend has risen since we picked this thing up in the portfolio there. It's about 43%. At the same time, the stock has kind of come down a little bit. That's a pretty striking anomaly, and I think we will see AltaGas. It would be one of my picks to do better next year, possibly have a very good year. So that's the last question, and I appreciate everybody tuning in. I do want to once again call your attention to the offer, which is $399 a year for 1 year. Promo code is special $399. You can visit the website there. You can call Sherry anytime at 1-877-302-0749. And again, the key is to use that promo code. We very much hope you will consider joining us at Conrad Utility Investor. So thank you, and Merry Christmas.